Hi everybody, and welcome back to our second video in Chapter 8. Here we're looking at a budgeting example. Number one here, Royal Company is preparing the budgets for the quarter ending June 30th. And the budgeted sales for the next 5 months are going to be April, May, June, July, and August. And they give you the number of units. Okay, the selling price is $10 per unit. Okay, so here we can easily put that into an Excel spreadsheet, and the individual months of April, May, and June are summed to equal the total budgeted sales in units and dollars for the quarter ending June. Here. And you can see that's just what they did, which totals a very convenient $1 million. Okay. All sales are sold on account, and that's very typical that we would do that. Everything is accounts receivable when it comes to selling our units. And Royal's collection pattern is that they get 70% of their cash collected in the month of sales, but 30% is collected in the month following the sale. So in April, the March 30th accounts receivable balance of $30,000 will be collected in full in April. Okay. So here's the accounts receivable ending March 31. All right. So now from the budgeted sales, here's our April sales. 70% of the 200,000 is collected in April. The remaining 30% is collected in May. And then May sales, same thing. 70% is in May, 30% is in June. Okay, so you can see that they're not going to get in cash 30% of June sales until July. Okay, so what will the total cash collections for the quarter be? So let's go back. And okay, and if you said $940,000, you'd be correct. And we get that, of course, by summing up all this. All right, now what will the total, the expected cash collections then we can put in here in the balance sheet, and it makes a lot more sense to see it this way. Accounts receivable at the end of June is going to be the 30% of the 300,000 that was sold in June. So our accounts receivable balance will be $90,000 at the end of the quarter. Now, we're going to prepare a production budget next based on what we sold. Now, here we need to have adequate product to meet the budgeted demand that sales is providing and to provide for the desired ending inventory. Okay? So once the sales budget's done, then we can move on to the production budget. You can begin to see the planning that needs to happen if you're going to do participative or budgeting during this process. So the management at Royal wants ending inventory to be equal to 20% of the following month's budgeted sales in units. So here on March 31st, we had 4,000 units that were on hand. So if Royal was a merchandising company, it would prepare a merchandise purchase budget instead of a production budget. But of course, manufacturing is more complex. So here is our 100,000 units that we're going to sell. And so from that, we have a desired ending inventory that's going to be 20% of the next month. So here we take 50,000 times 20%, and that gives us $10,000. That's what we want our ending inventory to be. So our total needs to be the sales plus the desired ending inventory. But we already have 4,000 in beginning inventory, so we can subtract that to get to our required production of 26,000. So now, what is the required production for May? Pretty easily, we would need to work that through. So what we would need to do is, we'll show you the answer first, and the answer is 46,000. And how do we get that? We take the 20% of June sales, that gives us the desired ending inventory. We add those together. Our beginning inventory is last month's ending inventory of 10,000. So that means $46,000. 46,000, I said, units. Okay, and if we do the June, we'll do that as well. Same way. Okay. So one little trick in this will point out, if you're doing a quarterly projection, you need to start with a beginning inventory for April here and an ending June inventory there. And that will give you the correct answer here for the required production of 101,000 units in the quarter. So now we're going to take a look at preparing the direct materials budget, including a schedule of expected cash disbursements for the purchases of those materials. Okay, so at Royal, they need 5 pounds of material for every unit they produce. So they want materials on hand at the end of each month to be equal to 10%, again, of the following month's production. And then on March 31st, 13,000 pounds of material are on hand. And this material costs us 40 cents per pound. So let's take a look at preparing that direct materials budget based on these assumptions. So here's our production. Now notice we're starting with production, not sales. So we've got our units. Now we need to know our material per unit in pounds. So that's an easy one given to us in the problem. So that's 5 pounds per unit. So now I know the number of pounds of material that I need to meet production needs and provide for the correct inventory. Now, I haven't provided for the correct inventory yet, so we need to do that. We need to add 10% of the next month's production needs. So 10% of 230,000 is 23,000. We add that together. Now we have the total that's required. But we already have 13,000 pounds, so we can back that out to get to the number of pounds for the materials to be purchased, which is 140,000 pounds. Okay. Now, how much should be done in May? I have to look ahead a little bit, and the answer is 221,500 pounds. How do I get that? I start with 46,000 production units, 5 pounds per unit. gives me my production needs of 230,000. I want a desired inventory of 10% of the next month's production needs. And that tells me my total needs here are going to be 244,500 pounds. But I've got 23,000 pounds from April's ending inventory, now becoming May's beginning inventory. So the materials I need to purchase, as the quick check indicated, was 221,500 pounds. Okay, so if we do the same thing for June, we can do that. Again, my desired beginning inventory then is or ending inventory, I should say, is June's ending inventory. But the beginning inventory is April's for the quarter. Okay. All right. Royal pays 40 cents per pound for its materials. 1/2 of a month's purchase is paid for in the month of purchase. The other half is paid in the following month. So on March 31, accounts payable balance is $12,000. So let's take a look at calculating the expected cash disbursements. Here, we had accounts payable beginning March of $12,000. We're going to pay that all in April. Now, for April purchases, let's go back. Here was April's purchases, 140,000. And so if I take 140,000 pounds times 40 cents per unit, that's going to be a total of 56,000. But I'm not going to pay for all of that in April. I'm only going to pay for 50% of that in April. The other 50% will be paid for in May. Okay. Now, what are the total cash disbursements for the quarter? I'll just jump ahead so that you have a chance to do that. You can stop the tape and do it that way. But here, the answer is 185,000. How do we get that? We go through all of these calculations, 50% and 40 cents per unit, and away we go to hit $185,000. Okay, that's expected cash disbursement for the quarter for materials. Okay, now direct labor budget. This is probably the easiest budget to prepare of these production budgets. So at Royal, each unit of production requires 0.05 hours, 5/100ths of an hour, 3 minutes of direct labor, not much, right? The labor can be unskilled because the production process is relatively simple and formal training is not required. It pays its workers at a rate of $10 per hour. So this should be pretty easy. What we do, we know the units of production here, and we know the time it takes is 3 minutes per unit. So what we can do is multiply the units of production times the labor time per unit here, and that gives us the total hours that we require. Now you'll notice that this is expressed in terms of hours already. Normally you're going to have to convert that from 3 minutes out of 60 units, 60 minutes in an hour to get back to the 0.05. All right, so now we know the labor hours required, we know the hourly wage, so we know the direct labor costs. Pretty straightforward there. That looks like a good well, let's just do this. What would the total direct labor cost for the quarter be? This looks like a good place to stop this video. And when we return, we'll take a look at this quick check 5. Until then, bye for now.